The number one job of a trader is to understand and control risk. It is one of the first lectures that I developed when we began SMB back in 2006. If you want to learn more about how short-term traders can control risk and not suffer unnecessary losses, stick around. I thought it would be fun to share with you a short portion of the discussion I had with developing traders about risk. I divide the subject of risk into two categories, internal and external. Internal risks are the things that we can control as traders. External risks are the things that the market presents to us. So here are a few minutes of my discussion on risk. If you enjoy this video, please click on the subscribe button. And if you want to learn more about the 3 top trades we teach on our desk, check out the free 2-hour workshop at the link above or go to tradingworkshop.com. As a trader, once you develop certain skills and you understand the best setups where the risk reward is favorable, what's going to determine how much money you make is your risk management. And from my viewpoint, there's 2 ways that I look at risk. It's the risk that we create ourselves by things that we do when we're trading or not trading, can impact when we're trading, and what's going on in the marketplace for particular stocks that we're looking at. So it's these internal things, trading techniques, emotions, and things that lead to us taking unnecessary losses. And then there's stocks, and AIG is a good example. On the open, there was some risk in that stock because it just did a reverse split. No one knew where it was going to be kind of trading right on the open. And so normally a stock like that, you might be risking 5 or 10 cents, but on the open, maybe the risk was 30 or 40 cents. So that was actually a situation that presented more risk, the situation itself. Now, how do you create risk by things that you do? Well, let's talk about, 4 or 5 of the top examples. And actually, if I don't mention one that you think is something that you can do as a trader, which creates a lot of risk, please just throw up your hand and throw it out there. Number one thing that we do to create too much risk is too much size. Okay? There's a size that you're going to be comfortable with. Now, obviously, when you start trading, you're going to be trading 100 shares. But you're going to start scaling up, and eventually you're going to get to a size for your skill level that you are comfortable with. That may be 500 shares, 1,000 shares, 2,000 shares. When you get to that level, and then you start to trade a multiple of that, say you're comfortable with 500 and you have a 1,500 share position or 2,000, you don't make more money. What happens is you actually lose money because you do not trade that position correctly because you're not comfortable with that amount of, let's say, money on the line, that amount of risk. So that's a really big thing to recognize. Obviously, it's not going to be an issue right at the beginning for you. And the way that we have things structured when you go live is that we scale you up very slowly based on your performance, and generally we start scaling people up and they don't even take advantage of that until they get comfortable. I mean, obviously you have people on the other end who want to push. But generally the traders who tend to be more successful in their first 6 months will say it's time for you to bump up, and we give them that extra ability to trade more size, and they're actually tend to be more cautious. And so they may have the ability to trade 400 or 500 shares, but they're still trading with 200. When they see a great setup, obviously that's when they're going to go to their max size. Okay, another thing that you guys have probably heard on the desk is this idea of flipping. The idea of you have a long position and then you go to short, and you have a short position and then you go to long. Very important to focus on which direction the stock is trending and stay with that. So if a stock is moving up and it stops and there's some selling, okay, that's a spot where you might sell some stock, maybe you even get flat, but that stock isn't a short. And there's very specific circumstances under which we will define trades for you that are trades to flip, and they're rare. It's just not something you want to employ normally. It's one of the big red flags when you start trading. If I notice you're trading a stock and you're long it, and then 2 minutes later you're short it, and then you're long it, that's not what you want to do. You want to get long, you want to get flat. You want to get long, you want to get flat. You want to identify which direction that stock is going and stick with it until something very significant happens and changes. It's something that your mentor will pick up on very quickly on your work as well. All right, other things that we can do to create risk. Over trading. Really good example. Someone just said before I started, the market's going to be slow for the next couple of weeks. Well, when the market is not doing that much volume, and if there's going to be less opportunities. And so normally maybe in a stock there would be 20 or 30 good trades in it during the day. Maybe there's only 4 or 5 opportunities. So over trading is, a lot of young traders have that tendency. When they start, they just want to jump in there and they see something and they want to make a trade. You really at the beginning want to establish that discipline where you wait for something significant. You wait for your setup. Good example yesterday was DVN I mentioned in the morning meeting. The setup was short below 55. Wait, watch the stock, see if you can identify some weakness before it gets to the level. That gives you confidence when it goes through the level that the trade's going to work. But wait for it. The trades will come, the setups will come. If you're waiting for a particular setup, have the patience to wait for it. What happens is if you don't wait for the setup and you start over trading, very quickly you take a bunch of small losses and any money you make on your good setups gets erased. So we don't want to do that. All right, other things that we can do. Covered flipping, too much size, not having a trading plan. That's a good one. Someone calls out, someone says AIG is at such and such level, and you punch it up and you immediately get long or short. That's not a trade. You punch up the stock, you talk to the people who are in it, what exactly it's doing, then you formulate a plan. Am I going to get long here? Am I going to get short? If it does this, am I going to get out? You just don't jump into a stock. You have to have a plan before you get in. Okay. The next thing is something that I think was really kind of big when we first started SMB. I think maybe only 15-20% of the newer traders have this issue now because it's something that's hammered home, and I'm sure it's been lectured to you already, and you probably can guess what's coming. It's get out of the stock when it trades against you. Hit the bids, pay the offer if you're short, get out if it trades past your exit price, and reevaluate. You do that consistently and you minimize your losses, the good trades are going to come, the profitable trades will come. If you have developed that type of discipline, at the beginning you think, oh, it's 100 shares, what's an extra $5? You're training your mind, you're training your habits, so when you're trading 2,000 shares, so you don't take a $2,000 loss. And trading is really about developing good habits. So if you develop the habit of exiting every time your exit price is hit, you're going to have that habit for the rest of your career, and you'll have a long career because of developing that habit. I hope you enjoyed that blast from the past. It's actually one of the many videos and written lectures from our DNA mentorship program that we use to train all of the prop traders on our desk. If you want more of that type of education, feel free to check out the free 2-hour workshop at tradingworkshop.com. Also, if you have areas of risk that you struggle with, or perhaps habits that have helped improve your trading, please share them in the comments section below. And of course, feel free to ask any questions related to risk in the comments as well. Bonus question, if you can guess how old I was when I gave that lecture, I will send you a free copy of this awesome book, Peak Performance Trading and Investing, that will help you to figure out the type of trading or investing you're most suited for.